Hello, my name is John and welcome to the Alice Beach Cookie Company final project for Management Applications of Accounting ACC 5301 with Dr. Arlene Goodman. Today we'll be talking about the backstory of Alice Beach Cookie Company, the contribution margin and break-even, full and variable costing, special order, internal rate of return, cash budget, material and labor variance, and finally, conclusions and recommendations. The backstory of Alice Beach Cookie Company started quite simply as a one-time project for a mother-daughter bake sale. Well, they produced a unique scone-like chocolate chip cookie that was consistently asked for thereafter. So throughout middle and high school, folks kept asking for the cookies. Well, they eventually started to form a company, and their mission statement was to bake simple cookies that are simply delicious. They use premium ingredients and provide excellent customer service. They're located in Alice Beach. It's a planned community in Walton County, Florida, on 30A, where everything is within walking or cycling distance. They have very luxury branded clientele who are willing to pay premium prices for premium service. With regard to the contribution margin and break-even analysis, the chocolate chip cookie is the best seller. No kidding. The specialty cookie, though it only makes up 11% of the sales, is the most profitable product. The sugar cookie, lowest sales by volume, is liked by the family and those who are a little bit indecisive. So it is a quite popular cookie for everybody else, and much like the middle child, it's often overlooked but still loved by the family, so it will always have a place on the shelf. For full and variable costing, creativity is appreciated in the design of the specialty cookie. However, it is not appreciated in accounting. So when we start talking about net operating income, it is the same under full and variable costing. And variable costing is 2.5% lower cost per unit. Too bad it's not accepted by the generally accepted accounting principles. So therefore, absorption costing, also called full costing, which is required by GAAP, will be used. It is also financially more conservative. So much like a motorcyclist who doesn't dress for success, he rides for the slide, always be prepared for the worst case scenario. So running through full cost accounting is definitely preparing for the worst. With regard to the special order, so Alice Beach Cookie Company has an opportunity to provide specialty cookies that will support a wedding. Now, as we know, in Northwest Florida, the tourist season starts to die off in mid-November. So timing is everything. So because business is cyclical, they have this opportunity, and they are going to offer the cookie at a discounted price. But because of the clientele, we're fully expecting a social media exposure. So good effects on that. Quantitatively, profit exceeds cost, so hey, it's still in the black, so it's a good opportunity. Qualitatively, it will have no impact on customer relations and no impact on normal day-to-day operations. So therefore, it should be accepted. For the internal rate of return. Now, what this is referring to is an opportunity to purchase equipment from one of the partner's brother. Now, the proposal is rejected because the internal rate of return is less than the acceptable rate required. The rate we have calculated is 8%, and we have determined that the acceptable rate is 9%. So it does not meet the threshold. So numbers-wise, the answer is no. However, the textbook response does state that net present value is, the decision that we should use. Yeah, however, some further investigations will be needed. So we'll need to know, what does it do? How's it going to gain it? And we'll start with a critical review and analysis of the company's earnings before interest, taxes, depreciation, and amortization. That's the EBITDA. And calculating the profitability should strip out the depreciation and amortization expenses, and then we can delve further into financing options to see if it really does make sense. So with regard to the equipment, much like a three-dimensional sculpture, a change in perspective can completely change the image. So the short answer for now is no. The long answer is we'll see, we'll investigate it, and maybe there is a possibility. Now, with regard to ethics, that's pretty clear. There is a potential for conflict of interest among the company partners. Why are you giving this to somebody else and not my family? So decisions really need to be based on finance, not family. If we keep it that way, it works out better. Now, when we start talking about the cash budget, so as we see our schedule, there is a dip in March. So January, February, March. So we're seeing a dip in the cash budget. Again, this corresponds with the cyclical nature of the tourist industry. So the function is to be able to plan the amounts, plan the timings of cash flows, and prior planning prevents poor performance. So we know for options that a cash reserve budgeted from surplus months will be needed to cover the deficit months. So clearly we're okay on that one. We also understand that the clientele, tourism business waxes and wanes. It's a matter of not if it's going to happen, but when it'll happen. So just simply being prepared is good advice. When we start taking a look at material and labor variances, again, this is where the numbers don't necessarily match reality. Let me explain. So the materials price variance is technically unfavorable. So if we check the cost of materials, the actual cost of direct materials is higher than the standard cost of direct materials. This is technically a problem, but not really. So when we take a look at materials quantity variance, this is mathematically favorable because we're using less than the standard amount of materials. Taking a look at the labor rate and efficiency variances. Again, both of these are technically unfavorable. You have to ask the question, is this a problem? And the answer is the Alice Beach Cookie Company serves a luxury market. They are a luxury niche product. So service and quality are what count. We're dealing with Porsches, not Pontiacs here. So you get what you pay for. Lastly, we get to conclusions and recommendations. So for the conclusions, if it's not broken, don't fix it. Total profits for the year is $2.7 million. That averages out to a monthly profit of $225,000. We have happy employees, we have happy customers. The employees earn more than the average in the industry, and they're more than happy to do so. Customers keep coming back, life is good. So that part's going well. When it comes to costing, variable, though technically 2.5% lower per interest per item. Yeah, okay, it's a little creative, but again, absorption costing, also known as full costing, is more conservative and required by GAAP. It's always better to, over budget than under budget. We can always do that. And lastly, when we start talking about ethics, when we're dealing with family problems, again, what we need to do is facts over family. It's just about numbers. It's business. It's not family. So we're good on that one. I'd like to thank you all for your time. Have a great day. Good night.